So imagine you've just run, I don't know, a massive trading simulation.
Oh, the classic scenario. We've all been there.
Right. You spent weeks writing the code, curating the data, cleaning everything up.
And you've probably tested thousands of variations of your strategy at that point.
Exactly. And finally, the algorithm spits out this configuration that generates like an incredible 16% return on data it has never even seen before.
The holy grail.
Yeah, the equity curve is just going up and to the right.
Huh.
And you're sitting there ready to pitch it to your firm or, maybe bet your own life savings on it.
Which is terrifying.
It really is. Because mathematically speaking, there is a near 100% chance that your beautiful, profitable strategy is completely worthless.
Yeah, it's a brutal realization. You are essentially looking at a mirage.
A very expensive mirage.
Exactly.
Right.
Because you've built a machine that hasn't actually learned how to trade the market. It has just learned how to perfectly memorize historical noise.
And that's exactly what we're getting into today. Welcome to the deep dive, by the way. Today, we are going to look at the exact forensic math designed to catch data when it lies to you.
It's such an important topic. Proving that something doesn't work is really the only thing that keeps you from vaporizing real money.
So true. And we are pulling from a single, intensely detailed source today. It's an article published just a few days ago on July 9th, 2026.
By a quantitative researcher who goes by Sunat, right?
Yes, Sunat. And the piece is titled The Honest Negative. Tens of thousands of backtests, 5 majors, no robust edge.
I love that title. It's part of their ongoing series, Backtests Without Illusions.
Right. And okay, let's unpack this because reading through this research felt less like a standard finance paper and more like, I don't know, a post-mortem on a financial illusion.
Yeah, it reads like a detective story where the detective actually shoots the suspect at the end.
Yes. The author took a strategy they genuinely hoped would work, subjected it to a battery of devastating statistical traps, watched it die, and then just published the failure.
Which is a massive capital-saving victory for anyone paying attention.
Absolutely. And the mission of this deep dive is to explore that exact machinery. We're going to break down the highly advanced mathematical tools that quants use to differentiate between a true market edge and just, well, a statistical fluke.
Because every good investigation has to start with a suspect.
And in this case, the suspect looked incredibly compelling.
What was the initial setup again?
So they started with an ordinary strategy, a Hall moving average crossover.
Okay, pretty standard.
Yeah, run on the cryptocurrency pair ETHUSDT, so Ethereum against Tether. And they were using a dual-timeframe grid.
Makes sense.
But what really caught my attention wasn't the strategy itself, but how deeply paranoid the author was about execution.
Oh, the execution logic is where most backtests fall apart.
Right. They enforced what they called a strict one-bar discipline.
Yes. That paranoia is the first hallmark of a real professional backtest.
Can you break down what that one-bar discipline actually means in practice?
Yeah, absolutely. So it fundamentally means that the algorithm evaluates its trading signal on closed bars, say the end of a 1-minute candle.
Okay.
But it operates under the assumption that it can only actually get filled on the open of the next bar.
Because in reality, the market isn't this fictionless vacuum, right?
Exactly. You can't magically teleport your order into the exchange's matching engine at the exact microsecond a minute bar closes.
Right, expecting to get that exact closing price.
It's physically impossible. By the time your local machine processes the close, calculates the moving average, and routes the order through the API to the exchange.
The market has already moved.
Exactly. The price is gone.
Yeah.
And if you don't account for that reality in your simulation, you introduce look-ahead bias.
Which is basically a data leak from the future.
That's a great way to put it. It happens when a backtest assumes you can transact on information before it was physically possible to do so.
And the author notes that even a tiny one-bar look-ahead leak can manufacture a Sharpe ratio of like 15.
Which is absurd. I mean, to put that in perspective for you, Renaissance Technologies' Medallion Fund, which is arguably the greatest hedge fund in history, is estimated to have a Sharpe ratio somewhere around 2 or 3.
Wow. So 15 is just...
A mathematical impossibility, yes. By strictly enforcing that fill on the next bars open, the author completely sealed the simulation.
Yeah.
No peering into the future at all.
So they have this completely sealed, honest execution model. And they run this dual time frame strategy through an out-of-sample test window.
And what did it print?
The results print an impressive positive 16.35% return.
See, that is huge.
And I push it even further into a completely untouched holdout window, and it clears that with a positive 2.62% return.
I mean, those numbers would trigger a celebration on most amateur algorithmic trading desks.
Oh, for sure. You have a clean execution logic, and it's making money on data the algorithm was not trained on.
It looks perfect.
If I saw those numbers, my finger would be hovering right over the deploy button. I mean, it looks like pure skill.
Right.
It's like watching a golfer step up to a course they've never played, take a single swing, and hit a hole-in-one.
You'd immediately assume you're looking at a master of the game.
Exactly. Most people would just stop right there, ship the code, and wait to get rich.
But the reality is, you aren't looking at a master golfer.
You're not.
No, you're looking at a guy who stood on the tee box and hit 10,000 golf balls into the woods, into the water, out of bounds.
Just swinging away in the dark.
Right. And eventually, one ball miraculously ricocheted off a tree, rolled over a bridge, and dropped into the cup.
Wow.
If the only footage you broadcast to the world is that single, final shot, it looks like pure genius.
But it's not. It's selection bias.
That is selection bias in a nutshell.
Which is essentially the silent killer of quantitative portfolios.
Oh, it destroys them.
Because we don't actually know how many failed attempts were quietly swept under the rug to find that one golden winner.
Exactly. The out-of-sample window was clean of a look-ahead leak, yes, but it was deeply infected by the selection process itself.
Because they didn't just test one idea.
No, the researchers didn't just dream up one specific set of parameters, test it once, and get 16.35%. They tested a sprawling grid of different parameters.
And if you hide all those failures from yourself,
your surviving strategy will inevitably fail when it meets the live market. It's guaranteed.
I mean, think about it. When you see top-performing results in the news or in some business report, how often do you actually know how many dead-end strategies were discarded?
Almost never.
Right. So if finding the winner out of a massive group is the actual problem, then the only way to find the truth is to count exactly how many attempts were made.
Which is where it gets really interesting.
Yeah, this is where the author's methodology gets fascinating. Because they didn't just run a few dozen tests. They ran roughly 37,000 distinct configurations.
37,000. And they didn't just guess at those configurations randomly either.
No, they used a Sobel QMC search across the parameter space.
Right, quasi-Monte Carlo.
Can you break that down for us? Because I know a standard grid search just tests every single combination sequentially, and a Monte Carlo search just, throws darts randomly.
Basically.
So what makes QMC different?
Well, a standard grid search is computationally exhaustive, but it often leaves these massive blind spots between the grid points if your steps are too wide.
Okay, so you might miss the sweet spot entirely.
Exactly. And pure Monte Carlo, which uses pseudo-random numbers, naturally forms clusters.
Like clumps on a dirtboard.
Right. You get clumps of tests in one area of the parameter space and massive empty voids in another.
So it's not efficient.
Not at all. But a Sobel sequence, which is what QMC uses, is what we call a low discrepancy sequence.
Low discrepancy.
Yeah, it is mathematically designed to fill that multidimensional parameter space as uniformly and evenly as possible.
So it spreads the tests out perfectly?
It ensures you are testing a truly representative sample of every possible variation of your strategy without having to run a billion combinations and melt your server.
So they cast this incredibly wide, mathematically even net. And out of 37,000 distinct swings of the golf club, the search algorithm kept the absolute maximum performer.
We want to hit the hole-in-one.
The 16.35% return.
Yeah.
But to understand why those 37,000 attempts mathematically destroy the credibility of that single winner, we have to talk about the false strategy theorem.
Oh, this is one of the most sobering realities in quantitative finance.
It really is. Developed by mathematicians David Bailey and Marcos Lopez de Prado, right?
Yes. And the theorem states a pretty devastating fact. It says that if you have a set of strategies and every single one of them has an expected true edge of 0.
Meaning they're all just pure noise, random coin flip.
Exactly. Even if they're all garbage, the expected maximum Sharpe ratio of that group will inevitably grow simply by increasing the number of trials.
Because if you have enough monkeys flipping coins, eventually one monkey flips heads 20 times in a row.
And suddenly that monkey looks like a clairvoyant. The math governing this is tied to extreme value theory. At around 30,000 trials, the absolute best performer out of a pool of pure noise will sit about 4 standard deviations above 0. Purely by luck.
4 standard deviations.
4 sigma.
I mean, in almost any other scientific field, a 4 sigma result is a monumental discovery. You'd win awards.
Oh, you'd be on the cover of magazines.
Yeah.
But in algorithmic backtesting, a 4 sigma result is just the shadow of your own search process.
Okay, wait. I have to push back on this premise gently.
Sure, go ahead.
If testing 30,000 strategies guarantees a massive 4 sigma winner just by sheer luck, how do we ever distinguish a lucky coin flipper from a genuine edge?
That's the million-dollar question.
Right. What if one of those 37,000 strategies actually was brilliant? Doesn't this theorem basically imply we can never test more than one idea without invalidating our results?
See, that is the central dilemma of modern data science.
It feels like a trap.
It is. You cannot stop searching because you have to explore the data to find inefficiencies in the market. But you also cannot trust the winner of a massive search using traditional metrics.
Like a standard Sharpe ratio.
Exactly. A standard Sharpe ratio is useless here.
Yeah.
You have to change the benchmark entirely.
Okay, so how do we do that?
Instead of comparing your winner's performance to 0, you have to compare it to the search itself. And that is the function of the deflated Sharpe ratio.
The DSR.
The DSR, yes.
Okay, so normally when calculating a Sharpe ratio, you compare the strategy's return against a risk-free rate, asking, is this better than just holding cash?
Right.
But you're saying that when you've run 37,000 trials, better than cash is the completely wrong hurdle.
It is entirely insufficient because, of course, one of them will beat cash purely by chance.
Right.
The DSR calculates the nose ceiling created by the variance of all those 37,000 trials.
It raises the bar.
It raises the benchmark to match the intensity of the search. It essentially asks, is the winner's Sharpe ratio significantly higher than what the absolute luckiest of 37,000 random coin flippers would naturally achieve?
Wow. Okay, so it reports the probability that the true edge clears that elevated, much harder hurdle.
Exactly.
So let's look at what happened to our ETHUSDT winner. On its out-of-sample track, the strategy posted a daily Sharpe ratio of 0.19.
Which, to clarify for you listening, a daily Sharpe of 0.19 over a sustained window is actually highly respectable in the quant world.
Definitely. But when the author plugged that 0.19 into the deflated Sharpe ratio formula, factoring in the weight of those 37,000 trials, the score dropped to 0.00.
Absolute zero. Indistinguishable from pure noise.
That's brutal.
The math didn't suggest the strategy was marginal or just okay. It stated that given how hard the parameter space was searched, a 0.19 Sharpe is entirely consistent with a strategy that has absolutely no predictive power.
It just won a statistical lottery.
Precisely.
But, you know, there is a massive nuance here regarding how they counted those trials, and I think it's vital for appreciating the rigor of this study.
Oh, you mean the clustering?
Yeah. They didn't just blindly plug the number 37,000 into the DSR formula because doing that would actually be unfair to the strategy.
That's right. It would be overpenalizing it. So they applied a technique called optimal number of clusters, or ONC.
Another framework championed by Lopez de Prado, right?
Yes. And to understand why ONC is necessary, think about the parameter grid itself. Testing a 50-period moving average and a 51-period moving average.
Or technically 2 different trials?
Technically, yes.
Mm-hmm.
But their trading signals are going to be nearly identical.
Right. Their returns will be highly correlated.
Extremely correlated.
It's kind of like taking a survey. If you ask 100 people for their opinion, but 90 of them belong to the exact same political party and share the exact same ideology, you don't really have 100 independent opinions.
No, you have about 11.
Exactly. If you count them as 100 completely independent variables, you're artificially inflating the size of your sample.
That analogy hits the nail on the head. If you feed the DSR formula 37,000 highly correlated trials, it will raise the noise ceiling impossibly high.
Punishing the strategy for what is essentially a bookkeeping technicality.
Right. So ONC solves this. It takes the correlation matrix of the returns from all the trials and groups them into hierarchical clusters based on their similarities.
So it groups all of 50, 51, 52 period averages together.
Exactly. It identifies the effective number of independent ideas that were tested rather than the raw number of parameter tweaks.
It's basically giving the strategy every possible mathematical benefit of the doubt. It lowers the hurdle to make it as fair as possible.
And here's the kicker. Even with that highly generous clustering correction folded in, the strategy still flatlined at 0.00.
Man.
When a result deflates to absolute zero after effective end clustering, you are not looking at a hidden edge. You're looking at a mirage.
So rationally, the strategy is dead. The math has spoken.
Dead on arrival.
But human psychology is incredibly stubborn.
Oh, definitely.
If a strategy fails on one coin, A stubborn trader might look at that point zero zero and rationalize it.
They'll find an excuse.
They'll say, well, Ethereum is just an idiosyncratic asset. It's got weird volatility spikes. The core logic of my moving average strategy is solid. It just got tripped up by ETH's specific market mechanics.
Rationalization is the most expensive hobby in finance.
That's a great quote.
Because a single symbol backtest has a massive structural blind spot.
Yeah.
Its only access for out-of-sample validation is time.
Time, meaning it just looks at future data of the same coin.
Exactly. It can tell you if a configuration held up over a later window of time on Ethereum, but it cannot tell you if the algorithm actually learned something fundamental about market microstructure or if it just perfectly memorized the specific historical quirks of Ethereum itself.
So overfitting to the noise of one instrument is practically invisible if you never leave that instrument.
You'd never see it coming.
So to close that loophole and prove without a doubt whether this strategy had merit, the author had to change the axis of the test.
From time to geography, essentially.
Right. Instead of looking at one instrument across different times, they had to look across different instruments simultaneously.
So they pivoted from a single symbol search to a cross-instrument search.
And what did they test it on?
They tested the strategy across 5 of the most liquid cryptocurrency majors: Ethereum, Bitcoin, Solana, Binance Coin, and XRP.
All traded against Tether.
All against Tether, yeah.
Now, the sheer scale of the data processing required for this is staggering. The author mentions analyzing roughly 1.18 million one-minute bars for each of those 5 coins.
Which is an insane amount of data. And managing that requires strict alignment. Every single coin had to share the exact same calendar window.
They can't just be randomly offset.
No, the data splits. The warm-up period for the moving averages, the in-sample folds where the search algorithm learns, the out-of-sample test window, and the untouched holdout window.
They all had to be perfectly synchronized.
Perfectly. If one exchange went down for maintenance and missed a few one-minute bars for Solana, those timestamps had to be reconciled across the board.
Just to ensure the strategy was evaluating the broader market under the exact same temporal conditions.
Exactly. They built a perfectly level playing field.
But how they evaluated the strategies on this playing field is what completely changes the game.
This is the crucial methodology.
Because they didn't rank the configurations by their average performance across the 5 coins. They ranked them by their median performance.
Right. And why do you think the median is so critical here instead of the mean average?
Well, it makes me think of a track and field decathlon.
Okay, I like that.
If you have an athlete who runs the 100-meter dash in absolute world record time, but they trip over every single hurdle and they throw the shot put backwards out of bounds,
Their average score might still look okay because that sprint was so freakishly fast.
Exactly. But they shouldn't win the overall decathlon. If a strategy makes a 100% return on Solana but loses 10% on the other 4 coins, its average is technically positive, but its median score is negative.
That's spot on. By taking the median, you are mathematically punishing concentration risk.
You can't just have one lucky outlier.
No, the mean average allows one freak outlier to drag the entire portfolio into profitability, masking the fact that the core logic failed 80% of the time.
Wow.
The median objective acts as a ruthless safeguard. To be selected as the champion, the algorithm must be at least moderately profitable across the majority of the assets.
It forces the strategy to be a true generalist. It demands that the logic of the algorithm, the way it interprets momentum and trend, applies universally to market mechanics, not just to the isolated behavior of a single token.
And honestly, this is a vital mental model for analyzing anything, not just trading.
Like business trends, health data, real estate.
Absolutely.
Yeah.
Robust truths usually apply across multiple domains. If someone claims they have a universal formula for success, but upon inspection, it only works on Tuesdays when it's raining in Seattle,
They don't have a universal formula.
they have an overfit coincidence.
Right. So they set up this ultimate gauntlet, a strictly harder cross-instrument median test designed to ruthlessly expose fragility.
And they push their absolute best configurations through it. Both the dual time frame models we discussed and an even more complex triple time frame variant.
And what happened?
It was a bloodbath.
A bloodbath.
Both the dual and triple time frame configurations completely failed. They crashed and burned.
But the author didn't just look at the final returns and call it a day, right? They used 2 specific statistical gates to measure the failure.
Yes, to really quantify it.
The first was the Deflated Sharpe Ratio, the DSR, which we already covered. They set the threshold at a 0.95 probability, meaning they needed 95% confidence that the edge was real after accounting for the massive search space.
And the dual time frame strategy scored a 0.24 DSR.
And the triple.
The triple time frame scored a 0.14.
So not even close to 0.95.
Not even in the same universe.
A 0.24 means there's barely a 1 in 4 chance the edge is even positive.
Exactly. But the second gate they used approaches the problem from a completely different angle. It's called PBO, the probability of backtest overfitting.
PBO. And that's calculated via combinatorially symmetric cross-validation, or CSCV.
Yes, CSCV is an incredibly powerful non-parametric test, where DSR evaluates the final winner of the search against a theoretical noise ceiling.
CSCV evaluates the robustness of the procedure itself.
Exactly. It asks a profound question. If I trust the in-sample data to pick the best strategy, what is the probability that my choice actually performs worse than the median out of sample?
Okay, wait, explain the mechanics of that. How does CSCV actually figure that out?
It uses combinatorial mathematics. It takes your entire data set and slices it into an even number of chunks. Let's say 16 slices.
Okay, 16 slices of time.
Right. It then generates every possible combination of grouping those slices into two sets: an in-sample training set and an out-of-sample testing set.
Oh, wow.
Yeah. If you take combinations of 8 slices from 16, that creates 12,870 unique paths through the data.
12,870 completely different timelines.
Essentially, yes. It runs the entire search process on the training set of path 1, picks a winner, and then sees how that specific winner performs on the testing set of path 1.
And then it repeats that 12,870 times.
You got it. It forces the strategy to survive thousands of different fragmented market regimes. It's evaluating the stability of the model's logic across every conceivable timeline.
And it is rigorous.
It is. It then calculates the rank correlation, usually Campbell's tau, between the in-sample performance and the out-of-sample performance across all those paths.
Okay.
And from that distribution, we derive the PBO, the probability of backtest overfitting.
Okay, so the author required a PBO of 0.2 or less,
Huh.
a 20% or lower chance that trusting the in-sample data leads to overfitting.
And how does they do?
The dual timeframe scored 0.264. The triple timeframe scored 0.327. Both failed.
Both failed the gates entirely.
But there is a massive misconception about PBO that the author emphasizes here, and it completely changed my understanding of these numbers.
It's a very common trap.
Right, because when I see a probability metric, my intuition tells me that 1.0 is absolute certainty and 0.0 is an absolute impossibility.
Right, but for PBO, the baseline of pure randomness, the null hypothesis, is not 1.0.
Well, it's not.
No, it is 0.5.
50-50, a coin flip.
Think about it. If your strategies have absolutely zero predictive power and you pick the best one in sample, your chance of it landing in the top half of performance out of sample versus the bottom half is entirely random.
So it's 50-50.
Exactly. So PBO 0.5 means your selection process is indistinguishable from flipping a coin.
Oh, I see.
A robust, trustworthy selection process will sit near 0.0, meaning the in-sample winner consistently remains a winner out of sample.
So when we look at the scores of 0.264 and 0.327, they aren't close to 0. They're dangerously close to 0.5.
They're essentially coin flicks with a tiny bit of bias.
There is a faint whisper of a signal there, but it is heavily drowned out by the noise.
But did you notice the paradox in those numbers?
Yes. This really broke my brain. When the researchers moved from the dual timeframe strategy to the triple timeframe strategy, they added a layer of complexity.
They gave the algorithm more parameters. They added a longer moving average to gate the signals from the shorter ones.
Right. And logically, if I give a model more context, if it can analyze the microtrends and the macro trends simultaneously, it should make better decisions, shouldn't it?
You'd think so. More data, more filters should equal better performance.
But adding that third time frame made the strategy mathematically worse across the board.
Yep.
The DSR dropped from 0.24 down to 0.14, and the PBO rose from 0.264 up to 0.327, moving closer to that 0.5 coin flip baseline.
It's the complexity trap.
Why does giving a model more information penalize it?
Because you aren't just giving the model more information, you are giving it more flexibility.
Flexibility to do what?
To overfit. This touches on one of the most fundamental concepts in machine learning and statistics, the bias variance trade-off. When you add parameters, like a third moving average time frame, you increase the model's degrees of freedom. You are giving the algorithm more knobs and dials to twist.
And twisting those dials allows it to perfectly match the historical data.
It allows it to memorize the historical data. Not learn it, memorize it.
Okay, I think I get it.
Think of it like a student studying for an economics exam. If a student understands the fundamental principles of supply and demand, they possess a robust, generalized model of economics.
So they can answer any question thrown at them.
Right, even if it's phrased differently than the textbook. But if the student instead memorizes the exact wording of the 20 practice questions they were given.
They'll score a perfect 100% on the practice test.
Exactly. But when they sit for the real exam, and the questions are slightly different, they fail catastrophically.
Because they learned the noise of the practice test, not the signal of the subject.
That is the exact fingerprint of overfitting. Every parameter you add to a trading model acts like an extra flashcard of pure memorization.
It gives the search algorithm the flexibility to curve fit the historical anomalies.
The inversion we see here, where adding complexity degrades out-of-sample performance, proves the model is crossing the line from generalization into memorization.
The complexity trap is brutal.
It really is. So the overarching math, DSR and CSCV, entirely rejects both strategies. The logic is fundamentally flawed.
But wait, if the strategy is this bad, how did the triple time frame champion manage to win the median test across 5 coins in the first place?
To understand the anatomy of this failure, we have to look under the hood at the individual asset performance.
Right, because the aggregate gates tell you that the strategy failed. But breaking it down symbol by symbol tells you how it failed.
And unpacking the how reveals exactly how algorithms trick us.
Okay, let's look at it. The author provides the per-symbol breakdown for the triple timeframe champion during its out-of-sample test window.
Remember, this was the strategy crowned as the best generalist across all 5 coins.
Okay.
Because it survived the median objective.
Here are the returns. On Ethereum, negative 0.39%. On Bitcoin, negative 0.38%. On Binance Coin, negative 8.58%. On XRP, negative 4.13%.
Okay, so 4 losers.
But on Solana, positive 14.74%.
Wow. When you lay the data out like that, the illusion just shatters.
It completely falls apart. This cross-instrument champion is profitable on exactly one of the 5 symbols. It is underwater on the other 4.
It's the decathlete who tripped on every single hurdle, threw the shot put out of bounds, false started the sprint, but somehow managed to pole vault 25 feet into the air.
The author phrased it perfectly. They called it a SOL specialist wearing a portfolio's clothes.
That is brilliantly put.
The single massive positive return on Solana is doing all the heavy lifting. Now, the median objective did its job, right? It mathematically demoted this strategy below the raw Ethereum winner we saw at the very beginning of the deep dive, because the median refuses to be entirely blinded by a single outlier.
Right, it saw through the facade.
But even the median selected champion ultimately leaned almost entirely on one lucky coin.
And the researchers had one final reality check to prove it. The holdout window.
Ah, yes. The holdout window.
This was the temporal block of data that absolutely nobody, not the algorithm, not the researchers, not the median objective, was allowed to touch or optimize against until the very end of the study.
The ultimate blind test.
Exactly. And on that completely untouched holdout window, the strategy returned a positive result on only 1 out of the 5 symbols as well.
So it wasn't a generalist at all.
Not even close. If the strategy had discovered a true fundamental market inefficiency, a real edge in how moving averages interact with crypto volatility, that edge would show up, at least faintly, across multiple instruments in the untouched data.
But it only shows up on one.
This highlights a phenomenon in data mining called moving edges.
A moving edge. That sounds like chasing a mirage in the desert that just, always stays on the horizon.
That's exactly what it is. True market edges do not migrate randomly. Think back to the very first test in the study. In the single symbol search, the supposed edge was deeply tied to Ethereum, printing over 16%.
Right.
But when the search algorithm was forced to look across 5 instruments, the supposed edge migrated entirely to Solana, and Ethereum went negative.
So the edge never existed. It was just an artifact of the grid search.
It was a localized pocket of noise. On the first run, the parameters perfectly memorized Ethereum's historical noise. On the cross-instrument run, a slightly different set of parameters happened to perfectly memorize Solana's historical noise.
Wow.
Real, robust edges do not jump from asset to asset like that. The algorithm didn't find alpha, it just found the path of least resistance through the historical variance.
This is such a fundamental lesson in data literacy, and honestly, it goes far beyond quantitative finance.
Oh, it applies everywhere.
Right. When a mutual fund, a tech startup, or even a real estate portfolio touts a massive aggregate return, They usually present you with a smooth, upward trending chart.
Everything looks great on the surface.
But if you don't unmask the champion, if you don't look at the component parts, you might be buying into a portfolio where 99% of the success is riding on one single lucky bet.
While the core business model is actively bleeding money.
Exactly. You have to differentiate between structural skill and concentration risk disguised as skill.
If you rely on aggregate numbers without demanding to see the variance underneath, you are setting yourself up for catastrophic failure when that one lucky pillar inevitably crumbles.
Which brings us to the philosophical core of the author's argument.
Right. The why.
Yeah.
We-
Why go through all of this effort? Why write thousands of lines of complex Python code, process over 5 million data points, calculate optimal clusters, and build this incredibly intricate forensic apparatus just to publish a failure?
Because the author understands that "we found no robust edge" is not a failure.
It's not, no.
It is a precise, falsifiable, and rigorously correct scientific finding.
But it's a finding that almost never sees the light of day because of the file drawer problem.
The file drawer problem. It is a systemic crisis across multiple disciplines: academia, medicine, psychology.
Can you explain what that is for those who might not know?
Sure. It describes the phenomenon where negative results experiments that fail to prove their hypothesis are quietly buried in a filing drawer. Nobody publishes a paper about a drug that didn't work.
Right, that doesn't get your tenure.
Exactly. But positive results, even if they are purely statistical flukes driven by bracking or selection bias, they get published, celebrated, and funded.
It completely warps our perception of reality.
Totally. If 20 pharmaceutical labs test a compound and find it does nothing, you hear nothing. The file drawers swallow the data.
But if the 21st lab tests it, and by pure random variance, some patients get better,
They publish it as a miracle cure.
that's terrifying.
It is. But in quantitative finance, the stakes of the file drawer problem are immediate and visceral.
How so?
Well, a buried negative result in a psychology journal might lead to a retracted paper 5 years later. A buried negative result in algorithmic trading leads to deploying millions of dollars of real capital, paying real transaction fees and exchange costs to trade what is essentially a lottery ticket masquerading as a signal.
I mean, think about the alternate reality of this specific case study. Think about how tempting it would have been for a slightly greedier, less rigorous team to look at that initial positive 16.35% return on Ethereum and just ship it.
They would have done it in a heartbeat.
They'd have a clean out-of-sample test. They'd have a positive holdout. They verified there was no look-ahead bias.
They would have written a beautiful pitch deck, raised a fund, and flipped the switch to go live.
And they wouldn't have known they were wrong until they crashed headfirst into the backtest live gap.
The Widowmaker.
Yeah, that's the terrifying chasm where the beautiful simulated equity curve ends and real money starts disappearing into the market.
Disappearing due to slippage, fees, and the complete evaporation of the overfit edge.
But a negative but honest result never has to explain the backtest live gap to angry investors.
Because it never goes live.
And that is the ultimate takeaway here. The true purpose of building rigorous systems, the deflated Sharpe ratio, the probability of backtest overfitting, the cross-asset median evaluations, isn't to bless your favorite strategies.
No, it's not a stamp of approval machine.
Its entire mathematical purpose is to stop you.
Its purpose is to violently reject the absolute best of noise before you mistake it for alpha.
That is so well said.
The value of this machinery is measured entirely, dollar for dollar, in the drawdowns you never took, the capital you didn't lose.
The strategy you desperately want to work is the exact strategy you need to scrutinize the hardest.
The quantitative machinery earns its keep the day it tells you no, not the day it flatters your ego.
So let's recap this journey. We started with a dazzling, almost hypnotic return on a single cryptocurrency.
It looked like a clean X-ray pointing right to a profitable solution.
But then we dragged that result into the light. We walked through the gauntlet of 37,000 hidden trials.
We confronted the mathematical gravity of the false strategy theorem and the noise ceiling of the deflated Sharpe ratio.
We forced the strategy to prove itself across 5 different assets simultaneously, evaluating it strictly by the median to mathematically strip away the outliers.
We unpacked the complexity trap, where adding more parameters actually degrades performance by memorizing the past.
And ultimately, we unmasked a supposed generalist to reveal an overfit specialist in disguise, proving that a rigorous, mathematically sound no is sometimes the most valuable asset you can possess.
The author built an incredibly advanced lie detector, hooked up their own deeply desired trading strategy to it, and respected the machine when it mathematically proved the strategy was lying.
That level of intellectual honesty is rare.
It is, and frankly, it is the only way to actually survive long-term in environments dominated by variance and noise.
It is the ultimate defense mechanism against our own biases. And I want to leave you listening to this with a final, lingering question to mull over as you go about your day.
It's a good one.
If the smartest quantitative data scientists in the world have to build these elaborate, multi-layered statistical traps just to stop themselves from being fooled by randomness in the financial markets, where else in your life are you mistaking a lucky streak, a hidden selection bias, for a reliable edge?
Are you evaluating your successes by the one shot that went in or by the thousands that missed?
The math doesn't care about the narrative, it only cares about the variance.
Exactly.
Thank you for joining us on this deep dive. Keep questioning the data, stay curious, and always, always count your trials.